All right, let's dive right in. Today, we're going to decode one of the most powerful signals you can find on a chart, the Dragonfly Doji. Now, I know what you're thinking, another candlestick pattern. But trust me, this isn't just some random shape. This thing is like a flare gun going off, signaling that the bottom might be in. So, let's get into it. You know, we've all heard it a million times, right? Just buy the dip. Sounds easy. But the real question is, when is the dip actually the dip? You jump in too early, and you're just catching a falling knife. You wait too long, and you've missed the whole ride up. It is, without a doubt, one of the most frustrating things in trading. But what if there was a specific signal that screamed, hey, the dip might actually be over?
Well, there is. And it looks just like a capital T. See, when pros see this shape, they don't just see a candle, they see a footprint. It's a huge clue that the sellers have finally thrown in the towel, and the big, institutional, smart money is stepping in with force to defend a price.
And this brings us to a massive myth that a lot of traders fall for. You see, most people are taught that a doji candle means indecision. You know, a pause in the market. But when it comes to the dragonfly, that could not be more wrong. This isn't a pause. This is the aftermath of a full-blown declaration of war.
So let's get this straight right now. A standard doji, the one that kind of looks like a plus sign, yeah, that's a stalemate. Buyers and sellers are pretty much balanced, nobody knows what's next. But the dragonfly doji? Oh, that is a completely different animal. That's a verdict. It shows that sellers tried their absolute best to tank the price, and the buyers not only fought back, they completely steamrolled them, erasing every single loss from the session. It is a sign of a violent rejection, not indecision.
So, what is it about this simple T shape that packs so much punch? To really get it, we need to pop the hood and look at its anatomy, because this candle tells one heck of a story.
So, technically speaking, a dragonfly doji is a candle where the open price, the high price, and the closing price are all basically the same. All the drama, all the fighting happened below that price, which creates that super long lower shadow, or what we traders call the wick.
But, and this is important, not every T-shaped candle is a true dragonfly. To be a perfect, high-quality signal, it has to be precise. That lower shadow, it needs to be really long. We're talking at least twice the size of the tiny little body. And the open, high, and close need to be practically on top of each other, giving it basically a zero body. When you see it, you'll know. It looks just like a perfect capital T. And that rarity is exactly what makes it so reliable.
Now, you might be sitting there thinking, hey, that sounds an awful lot like a hammer pattern. And you'd be right. They're definitely related. Think of them as cousins. But the dragonfly is the stronger, more aggressive cousin. See, a hammer has a small body, which tells you buyers fought back and won some ground. That's good. But a dragonfly has almost no body, and that's the key. It means the buyers didn't just win some ground, they took back everything. It's a much more definitive, powerful signal of rejection.
Okay, so this all sounds really good on paper, but does it actually work, in the real world? Well, this is where we stop just spotting patterns and start talking about a data-backed strategy.
There's one number I want you to burn into your memory, 71%. That's the back-tested success rate for a bullish reversal when a dragonfly doji shows up under the right conditions. That is a serious edge.
But, and believe me, this is a very big but, you don't get that 71% just by spotting a T on your screen. You have to follow 3 critical rules. Rule number 1, location, location, location. It has to show up at a key support level, a price where buyers have shown up before. Rule 2, confirmation. This is non-negotiable. You have to wait for the next candle to close higher to prove the buyers are for real. And rule 3, volume. That rejection has to happen on a big spike in volume. In fact, volume is so critical that some analysts figure a high-volume dragonfly is 5 times more reliable than one on low volume. And why is that? It's simple. High volume means big money is making moves. It means it wasn't just a few retail traders pushing the price around. It was a broad institutional decision to defend that level.
And that leads us to probably the coolest part of this whole story. Because the Dragonfly Doji isn't just a pattern that passively appears. Oh no. It's often the direct result of a very clever and very aggressive trap set by the big institutional players.
That long wick, it's not just a rejection. You should think of it as the footprint left behind after an institutional stop run. It's basically a trap designed to prey on market psychology.
because the big banks know exactly where all the retail traders, like us, place our protective stop-loss orders.
So here's the playbook, step by step. First, there's the bait. The institutions deliberately push the price just below a major support level. Second, the trigger. All those stop-loss orders from retail traders get hit, creating a massive wave of automatic sell orders. Third, the sweep. The institutions then dive in and buy up every single one of those sell orders on the cheap. And the result? The price snaps back like a rubber band, creating that huge rejection wick of the dragonfly. You are literally seeing the evidence of the trap they just set.
So how do you trade this like a pro and avoid getting caught? Simple. Here are the rules. 1. You always wait for confirmation on that next candle. Patience is everything. 2. You place your stop loss just a couple of pips below the absolute low of that wick. If it goes there, you are wrong. 3. Because your risk is so small, you should be targeting a profit that's at least 3 times bigger. And finally, trust the higher time frames. A dragonfly on a daily chart is way more powerful, like 40% more reliable than one on a 15-minute chart.
Now, before we finish up, I have to give you one final but super important warning, because where you see the dragonfly is every bit as important as the pattern itself. So, we've spent all this time talking about the dragonfly as this amazing signal for a market bottom, a bullish reversal. But what if you see the exact same T-shape at the very top of a huge uptrend? Does it still mean buy, buy, buy? No way. Not even close. Context is king. At the bottom of a downtrend, yes, it's a classic buy signal. But at the top of an uptrend, it's actually a bearish warning sign. It acts a lot like another pattern called a hanging man. It shows you that for the first time in a while, sellers had enough muscle to seriously push the price down during the day. Even though buyers recovered by the end, it's a major crack in the armor of that uptrend. It's a sign of weakness. Okay, so let's quickly recap your new Dragonfly Doji toolkit. First, remember, it is a signal of violent rejection, not indecision. Second, you're looking for that perfect T-shape at key support and on high volume. Third, to get that 71% success rate, you absolutely need confirmation. And finally, never forget that that long wick is the footprint of the smart money making its move. So I'll just leave you with this one question. The next time you're scanning a chart and you see one of those little doji candles, are you going to just dismiss it as market indecision, or are you going to look a little closer and see if it's actually a powerful declaration of war?